Today's discussion is all about valuation. We talk about, as OptiGrowth, we talk about making your business sellable very often. And it's one of the key methodologies we use in how we look at a business and how we put down key performance indicators for a business. So we thought that today, considering our current state of pandemic and considering the lockdown status we have, I'm sure we all feel that our businesses may have taken a knock or probably trying to survive through this, which more than likely would mean that our revenues cycles have been knocked slightly, or that we have incurred expenses without much revenue coming through. So now is as good a time as ever to have a look at your valuations and to understand what the valuation looks like. So a reminder, these sessions are all about connecting. So it's not just about Damion talking to you guys, it's about us connecting, having a chat, sharing some relevant business information, some news about what's happening with regards to lockdown, and just a nice way of maybe sharing some thoughts as business owners in a forum run by business owners, but also jointly spoken to or among business owners.
Damion, I just want to join in and say good morning to everybody as well. I hope you guys are well. Once we haven't seen each other for a long time. Anthony, I see you in all the way from Kenya. So Cara, good morning again. Helen, nice to see you guys. There are a few more people. I got a few WhatsApps, Damion, but I think we must carry on. They can always catch up a bit later.
Thank you. All right, so a reminder, we do have a shared folder. So in that shared folder, we've got tons of information with regards to how to manage these tough times, how to put together processes or policies, how to restart your business if you haven't restarted or opened yet, or even now that you have opened, how do we move forward if we do find ourselves being infected, or if you find staff contracting the virus or moving forward. So there are loads of information or items you can look at or templates you can use in that folder. Secondly, we also have a YouTube channel. So if you have missed any of our check-ins, you can go onto our YouTube channel at OptiGrowth and you can subscribe and you'll get notifications of every time we post up a video. This discussion or webinar will also be posted onto YouTube. So if you want to catch up or re-look at something, you're more than welcome to go to that platform and have a look. A quick reminder about the returntowork.co.za. This is just a government-run or government-sponsored website to share information with regards to how to open your work in a safe and incorporating environment. The idea here being that we want to try and protect our employees, protect our customers, and also protect our key stakeholders. You will also notice that, or I'm sure you would have heard, that government have also put a lot of the onus or responsibility on the business owners to make sure that they are in line with all the regulations or in line with all the needs for protective equipment and all those sort of things. So as business owners, we need to make sure that our working space or that our staff and customers are abiding by what government has set down as regulations or guidelines of how to operate. All right. So as I mentioned, today's discussion is all about how do we assess your business value. The idea here being that we want to make sure that you have a firm idea of what your company is priced at, I suppose, but also what your company is potentially valued at. So there are a few ways that us as business owners can start dictating or affecting that value. And the idea today is just share some insight into, firstly, how do we look at evaluation? Secondly, how do we, as business owners, potentially affect that value? So how do we either justify its value or how do we improve it? And then hopefully from this discussion, you as business owners can take away or walk away with some insight into how to potentially grow or start strategizing to grow that value of yours. If you want to, there are multiple means of getting valuations. So I'll run through some of those methods, and hopefully you can also use that to your benefit as well. All right. I think before we start going, as I mentioned, for us, sellability is a really key comment. So for me particularly, if your business is sellable, that means you have options. Now, sellability and having options is all fine and well. If you don't know what your business value is, if you don't know how much your business is worth, the chances are you don't understand what that value is, and you actually don't really know if your business is sellable or not. Because sellability means I have an option to choose. If somebody walks along and they decide to give me an offer today, how do I then know that that offer is either real or that offer is fair or that offer is market related? So if you don't know your value, you're already a step behind or a step away from understanding, is your business sellable or not? We discussed a personal financial portfolio a few weeks back, and I just thought I'd bring this slide back up again to remind us that as personal and as business owners, we tend to have three ways of generating income or generating wealth. The one is through our business. So our business is an asset. Our business holds value, but our business also brings about a income stream for us as business owners or as employees of that business. The second part is our personal savings. So we call it the three pockets. So the other part is having our personal savings accounts or investments away from our business. And the third is having our personal income stream. So our personal pocket for budgeting and spending. So as part of your for your personal financial portfolio, your company and the wealth your company can generate you plays a big part of it. So if you don't want to value your company for a valuation in a business sense, it's still important to make sure you value your company to make sure you understand how that affects your personal portfolio. Because again, if we ever want to look at getting things like bonds or financing or loans in a personal capacity, the bank will be interested to know what you value your company at and what your total value is or your total wealth is for you as a business owner.
Damion, it's worth mentioning that beyond those three aspects, your business, your personal values, and what you are worth as a human being in relation to your business, that is a silent partner called SaaS. And SaaS is sitting there waiting to hear what your values are so he can actually tax you. So there is this important aspect as well.
All right. So when we do talk about understanding your business and knowing where your business is, we tend to look at four stages of a business. So startup, it means you've got a good idea, you started running or opening your company, and you now started selling and started making some money. But it's still about survival. It's still about understanding that I'm not at the point yet where I can sit back and the business will bring in income on a continuous basis. I'm either scrapping for capital or for cash. I am working every second of every day trying to generate something and build something. And if I don't work that hard, the chances are the business will fall flat and not last. So the first stage of maturity is looking at how do we get out of that survival stage? How do we push past that startup stage? The next part looks at a lifestyle. So now the business starts being able to afford your lifestyle. The business starts being able to put money into your pockets that you can live on, that you can live off. And at this point, most business owners tend to be happy with where they are. They tend to become comfortable, and they tend to be in a position where they are content with what their business can produce for them. The problem with being in this stage, and there's nothing wrong with it, but there is a drawback to this, is that at this point of this stage, the business is still very reliant on you as a business owner. You are still actively either working in the company or directing the company. And the chances are that if you remove yourself from the business will start to struggle or either stutter along. So the next stage of getting past that point is how do we start putting in processes or start putting in the foundations or the building blocks to rapidly grow my company. And to rapidly grow, there obviously comes complexities. There becomes we start getting, the issue about how do we start delegating tasks, how do we start building strategy to incorporate more of my stakeholders, and scaling talks about how do I put in these structures or these the mechanisms so that I can start removing myself from the company and have the company run on its own 2 feet. And in that way, the company is able to grow rapidly. The company is able to start moving forward, and the company can start leaving you behind effectively of being a needed party to make the company grow. And once we get past that point, the last state of maturity will be, is my business sellable? Now, again, like we mentioned all the time, sellability means we don't have to sell. It just means it gives us options to choose how we want to go about our business. So we can work on our company and not in our companies. And when we talk about sellability, the options we have available to us start being, I can either sell. So if I get a good enough offer, an offer I buy into, an offer that I agree with, I can then sell either the whole entity itself, or I can sell my shares in the company to either other shareholders or other investors. Or if I'm the only owner or the sole owner, I can sell the entire entity and take that money and do what I want with it. Either go retire, start something new, invest, however I feel fit. If my business is sellable, it also means I've got the opportunity to scale further. So because my scaling structures are put in place and scaling is happening already, the chances are I can look to grow that business further and more than likely enhance that value anyway. The other options are things like looking at passing it down to either the next level of managers or even keeping a legacy going of your own or your family's and passing it down to your kids or your grandkids or something like that or at some points. And the last option is taking more of a strategic role. So either as a chairman of the board or as the visionary leader or as something where you're no longer actively involved in the day-to-day runnings. Instead, you are now the person who is guiding and steering the business in a direction that was intentionally meant, or helping the shareholders find the value in their business through that directorship. All right. So when we talk about valuing businesses, the first and foremost rule is that we have to have a willing buyer, willing seller scenario. So what that means, we have to be able to come to a term as the seller and with the potential buyer of what the fair value will be for that stake or that entity or for that asset. And the idea here being, if you use the example of something like your house or your apartments, if I put an offer down on an apartment, that offer can either be below, above market value. It can be a assumed value, an emotional value. But as long as the seller of that property is willing to meet me at that point or negotiate to that point and we come to a fair value or fair agreement of what their business is worth, then nobody can actually judge us from a perspective of, was that the true value? Because the whole angle here will be, if I can agree to it as a seller and I get the money I want out of it at an arm's length agreement, the chances are that value is what both parties hold as fair value. The biggest question about fair value will be, how do I justify, or how do I bring about motivating of what that fair value is? How do I know that that is a fair value? And particularly in a business,
Damion, just before you move on, so quite interesting. We had a customer who approached us, and he asked if we could give him assistance just to try and get to some sort of understanding how to get to the value of his business. In his mind, him and his partners believed the business to be worth about 5 million, between 4 and 5 million rand, just as a snapshot. And when I spoke to them, I could immediately see that they had a passion. They were very emotional about the business. It's their baby. They built it from nothing. But there was somebody who was interested to actually buy into the business or take over the actual major shareholding in the business. And he actually wanted to offer them nothing, so like zero. His contribution was going to be, he's going to act as a director on the board for a percentage shareholding as a shareholder, and then he will help them to drive the business and improve the value from nil to whatever the target would have been in those cases. So they started from nil, zero value, to 4 to 5 million rand kind of value. Now, it's a vast discrepancy between the two, and how do you get to that middle point that you can actually talk about your business, your baby, that is worth something? And I think today's discussion is learning towards that.
I think on that point, the first thing is to not call it your baby. So the first thing is to actually remove yourself emotionally from it and try and look at your business objectively to understand what would an outsider look at it. Because immediately when you call it your baby, the chances are there's an emotional attachment to it already, which already will probably push your valuation up.
It will be interesting to know. I think all of us on a call today have got the emotional inclination to call it our baby, or to refer it to as our business that started with nothing and we build it up into something. And how can there not be value, So I think it's natural for entrepreneurs to be connotated with business in an emotional way, but to realize that you've got to bring the value to that.
So to that point, then, when we look at how do we start justifying that value, how do we start putting across what that value is fair, or what fair value that is, we look at what we call the eight elements, the 8 factors of that business. And again, the whole point here is to try and be objective, to try and show an outside party what the business is doing and not have to explain to them. So one of the easiest ways of thinking about it is, if I've got to try and motivate a valuation to somebody, but I've got to constantly explain to them what's happening, or constantly try and prove to them what's happening, because I can't physically show them what's there. I can't put it on a piece of paper, or I can't push it through. The chances are the value isn't truly there then, because there'll be too many issues or questions around how I got to that valuation. So the first element to consider, and for most of you, you would have heard this 1,000 times, but I think it's just good to reiterate it. We have to understand that there's a financial element to anything in our business. So we have to know, firstly, what is the history of the company? So what are the previous results of the business, right? And then there's got to be some sort of looking forward of saying, is there a forecast in place to show somebody, or to show the stakeholders or my shareholders or my potential investors where I see this business going to? And the question will then be asked, how relevant or how factual or how risky is it to make that future prediction? Now, as we all know, forecasting is not very, very easy. Forecasting is something that we tend to try and neglect because it is difficult. But again, a forecast is a target. A forecast is something that I see or I push towards happening. The question will always be, how reliable will that be? And the one way of trying to justify that is putting together something like your sales plan and looking at how scalable your business is and where my growth elements are. So when we talk about scalability, we talk about, can I sell less to more people? Can I find items or products or services in my company that I can sell less to more to? And what do those products look like? What are those revenue streams in my company that I can start pushing out? And can I show any potential investor what those revenue streams are? Now, one big mistake that most business owners or businesses tend to make is when they share financial statements, they tend to share a broad-based sales figure. They don't show you what those revenue streams are. And scalability and growth talks about, can I identify what those revenue streams are? And can I work out what the profitability, particularly the growth profit of all of those things are, where we can push around and we can um, justify how valuable or how profitable those products are compared to how much I'm paying for them. So how much I'm selling them for. So then also looking at things like pricing structures, pricing points, price margins. And again, by showing any potential investor what those things are, I can start showing that this business model actually works. All right. Then we look at risks. So how do we eliminate the three biggest risk areas of any business? Either having a reliance on one key customer, one key supplier, or one key employee. Because any reliance on any one of those three elements tends to leave me at risk that if that customer, supplier, or key employee leaves, the chances are the business will be struggling. So my forecast, any justification I had with the reliance or the predictability of that forecast gets shot down very quickly. Now imagine if a company or your company has one big customer who takes up 80% of your revenue. Now, what is the guarantee of that customer leaving? Or what is the guarantee of the customer staying? But what is the risk of the customer leaving? And how clearly can I show somebody that either I'm going to mitigate that risk by getting more customers on board, or that customer is bound to me for some other reason, either through exclusivity or because I'm the only person selling that product or service within the industry. And the same will go for suppliers. If I have one supplier who I'm constantly relying on, and that's the only supplier I have, it's a huge risk to any supply chain that I may have in that business as well. And of course, I mean, key employee, I think, is the obvious one. If you as a business owner are the key employee, you are the intellect, the knowledge, the doer, the seller, the deliverer, the everything, and you remove yourself from the company, will the company survive past you? Cash flow, I think, as always, is a very key one. So if you don't have cash, you can't spend it, right? And unfortunately, in business, we need to spend money, we need to draw salaries, we need to pay suppliers, we need to invest in marketing. And without that cash or without that working capital to put forward, how do I then justify that the business can actually survive? I may have good profits, right? But as we all know, revenue is vanity, profit is sanity, and cash flow is reality. So even though I'm showing good profits, if I'm not pulling that money in and putting that money back into the company, how do I show anyone that the company is actually working? And secondly, do I have cushions? So if I've got some cash flow, do I have enough cash in the business to have a bit of a cushion or a bit of a protection element or a safety net should something go wrong? So obviously, the more cash we have in the company and the less any new investor has to put money down to keep the company going, the better your valuation would be as well. Recurring revenue talks about how predictable is my income. So can I show any potential investor or any potential buyer that I have a revenue stream that is predictable? And what that means is I don't have to go out and sell for every single sale I make. Every month, or to some portion or extent, every month I get money coming in and on a recurring basis that I don't have to go out and chase again, which means my cost of acquiring customers come down, but it also means that my lifetime value of a customer is extended, and therefore means I get more revenue or money out of it. Is my business truly differentiated? So how do I compare my business with my competitors? Am I in a niche market, or am I in a business where I'm constantly outdone or outshone or outplayed my competitors, and I don't have a big stake in the market I play in? Because if that's the case, it means that my service, my products are very easy to substitute with another one. And when that happens, it means that your customers can tend to leave you, or they can move to your competitors rather than you. So how do I justify to any potential person looking at valuing my business that that's not the case, that I am different, that I do have something that's better than what my competitors are offering? Customer service. So again, when we look at future forecasting, the one way to try and show somebody that you have a hand or a grasp on what your customers want is by showing them your customers are willing to promote your services or your products. So if I've got a good score of how my customers are promoting my products and services, it means I can justify that forecast or that target I put in place. Because if my customers buy into me and my customers want to use my service, the chances are more than likely that if they're promoting my services to other people, friends, families, and colleagues, that they will stick with me and they will bring more to the company. So by having a good client service portfolio, or by being able to share results of how your clients see your business, you can start justifying how well your forecast is done as well. And then lastly, do I have a company structure in place that allows me to delegate tasks out and let people be the experts in a particular function of the business? So as a very easy example, firstly, if you are a jack of all trades and the master of none, it means that you're doing everything at a sort of average basis, right? But has the company built a structure where I have an expert finance manager who makes sure that my accounting policies are in place, who makes sure the forecasting and the management of my financial controls are in place? Do I have an expert HR officer or an expert HR director in place to help get the best and achieve the best for my staff and drive through key elements with regards to the HR function? Do I have experts or technical experts who run on delivery? Do I have great sales staff who are focused on selling and driving revenue in the business? Now, the problem is if I don't have those structures in place and I can't show that there is a delegation of roles, I become trapped in the company. Because again, if I'm the key employee, how do I remove myself and not have the business fail? And putting a company structure in place and making sure that those functions are delegated down to particular experts also helps the investor see that, look, if I remove the owner now, I can take his company forward without having to do much work and drive much of a change here. So obviously, the more I as an investor or buyer have to put in, the more I'm going to expect the value to drop, because I'm not going to pay a premium for something I would invest more in, right? So maybe at this point, I mean, I'm sure you guys understand all the 8 factors. Anyone have any questions about this, or doesn't quite understand what being objective is, or being able to show rather than speak what your value is, or justifying your value? I'll take that silence as a good thing. Helen, I see you've unmuted yourself.
Hi, can you hear me?
Can you now?
Oh, okay. Sorry about that. So my question would be, so kind of wrapping my head around, the key person positioning, because I think we all having to think about that. Would that mean, so if we position ourselves, we have key people in the various function positions within the business, right? So operationally, they are providing the service. I'm struggling with understanding how I'm not still the key person if I'm still having to think and establish the strategies. I don't know if that makes sense in any way. Is that I still feel like there's a key role that's being played by me fulfilling that role as well.
It makes sense. So the answer would be, we then have to look at the structure of business again. So how do we differentiate between the employees running and the employees operating versus the board of directors who are responsible for strategy and vision, right?
And the thinking of it, yeah.
Thinking of it. So if you're the only person sitting at that board level, right, then it means you are still the key person who's driving strategy and vision. The question will be, if I start delegating tasks down, so I start growing the board structure, right? How do I then start differentiating what that board does? So do I either have a person who's got an expertise in strategic development or business development there? Do I have somebody who's a financial expert? So I start taking away the strategic elements that I'm dealing with every day, right? And if I remove myself, there may be a small gap or a smaller gap, but that gap isn't as big as me being the only person there. So remember, when we talk scaling again, scaling also means that while I delegate tasks down from an operational level, I've got to also start delegating tasks at a strategic level. Right? So Helen, as an example, I mean, you're probably a great educator, right? And you're probably great at doing a lot of things. The question will be, how good are you doing? Are you at marketing, or understanding marketing theory, marketing strategy, right? Or business development, or financial controls from a strategic perspective, right? So the question will be, well, how do we start moving your board around to start being that specialist strategic hub where you are part of it and not the only person doing it? Does that make sense?
It does, but it's still, there is still a question mark there, because on the back of, you can't, it's difficult. I don't see at what point you won't completely let go, right? Because you still have to, even if you appoint these various people within those key positions, even if I get a business strategist in, for example, that business strategist still needs to
take over.
I still have to drive that or influence that strategy. Otherwise, they won't know what direction my intention as the business owner, is. So I'm just trying to figure out that balance that we're all trying to find, where we can actually kind of step back. I deal with my strategist, for example. I still have to be involved in that sense. And
so as an example, Helen, when somebody buys a company out, as an example, I think it's extremely rare that a company buys out the owner just walks away, right? So what tends to happen, it tends to be an exit period or an exit term. So when a company is bought out completely, the owner stays on as either a director on the board, or the owner stays on as a CEO and starts delegating tasks out or tasks down over a 3 or 2 year period, for example, which means that owner has 2 years to get the business to operate without them, so they can move away in totality. But it's very rare that the company is sold and the owner just walks away immediately. There's got to be a sort of handover or a passing down of that before they just walk away. But the question will be, how easy is that handover? If the handover is as easy as a year or 2 years, that again will improve the value of your business, rather than just not being worth anything. Because again, the risk would be, as soon as you go, what happens to the company then?
Yeah.
Make sense?
Yeah.
Awesome.
Thanks.
All right. So once we have a way of justifying a value, or once we have a way of understanding that we can show somebody who's an external person, who's objective about the business, objectively what that business is worth. And when I teased Henk about talking about my baby, right? When we removed ourselves from thinking about the emotional state of my company, the question now will be, is how do I put a physical value to it? What method do I use of putting a value to that company? And essentially, there are multiple ways of doing it. The question will be, what is the best approach for you? So there are generally 3 considered ways of valuing your business. The first, we look at a cost approach. So generally, when you're looking at something like a factory or a production unit or something like that, the question will be is, what will the cost be to build that unit? Or what was the cost to build that unit, or build that factory, or build that environment, right? And that'll mean machinery, it'll mean equipment, it'll mean building and materials, it'll mean a whole range of things, right? What is the cost of getting that set up done in totality? The problem with the cost mechanism or cost valuation is, depending on the time that factory's been run or that building's been run, we tend to lose the value of that building. So another way of doing a cost approach is looking at how do we replace equipment or replace the structures or the equipment there. Now, as you can imagine, that's one way of looking at it, but what we miss out here is how it's run, right? So unless everything's robotic, unless everything is run through an algorithm or done somewhere, the chances are there's a mechanism that's used, or a process that's used, to make that operation run effectively. And the question will be, is how do we then value that? The cost approach is one way of finding a number figure. The problem will be, is how do we put a value to the operational process? Kieran?
How's it, Damion? I just wanted to share the experience that I went through in terms of a business that I was working with when 50% shares were sold. In terms of valuing the shares, they used the cost approach, but they didn't use the valuation of the assets on the balance sheet. They actually had an independent valuator come in, and they used that to negotiate the price to sell the business or the shares for.
Okay, so perfect, right? So in a similar sense, then the question will be, is what is the other ways of looking at the valuation then? So we've got the cost approach, right? Then we look at what is the market approach. What is the relative value of that business in its market? Now, it's not every day the businesses are sold. It's not very public unless it's a public entity that's selling, right? But the chances are that if you look at a public company, you can look at what the price per share would be for that business. And what we then start looking at is how do we start factoring ratios? And now this is where we get a little bit technical on balance sheets and all those great things. But how do we look at ratios of determining a value through either EBITDA, or how do we look at a ratio or a factor? When I say factor, I mean multiple. How do we look at either EBITDA, or how do we look at your revenue or your gross profits, right? So what that means is if a business is selling for, let's say, 3 times their revenue on average, and you put a value to that business again, or of that business to your company, you can use that relative valuation for your business. So as an example, for OptiGrowth, we are a business coaching consulting firm, right? We can look at what the mechanisms or the ratios used for industries similar to ours have been sold, and add that or use that same valuation then of how our business is approached. So either take our revenue or take our EBITDA amount and times it by a certain factor, right? Again, the problem with that starts looking at those companies are probably a lot more mature than what we are as small business owners. So how do we compare an immature company compared to a company that's probably a lot more mature than we are, and get a true or a real value? Because in this case, the last thing I want to do is to walk up to a potential buyer and give a valuation that's completely out of the park, and that person will look at you and go, "Are you crazy? Why? How do you compare yourself with a EOH or something to that effect?" Right? So if we can't look at public companies, the question will be is how do we look at something else? And a precedent approach will look at how do we look at something like a merger and acquisition. So something where another business has been bought, or another business has incorporated a company into their structures or their group holding. And again, the same thing will apply here. What value or what factor or multiple did that company use to predict the value of that business? All right. And then going to Karen's approach a bit more, as you discussed now, was looking at a discounted cash flow. So when we look at a discounted cash flow, we talk about a net present value. So this approach, we look at the actual company's value or company's cash flows. We look at the company's asset balance, and we look at the company's forecasting, and bring that down to a value that will be worth today. And hence why there's a relative value and an intrinsic value. Okay. So when we look at discounted cash flows, we look at what is the company forecasting. We add a discount rate to that, or an interest rate to that a potential risk would have to that business. And we bring that, or we use that risk factor and bring it down to a valuation that's worth today. And to do that, we have to consider something called the time value of money. So 100,000 Rand in 5 years' time won't be worth 100,000 Rand today, right? So there'll be a difference in value contact to that money, or to that profit or that cash at that time. All right, I know it's a little bit tricky, but we'll give you an example of how that works now. From an OptiGrowth perspective, we do enjoy the discounted cash flow more, and the reason why is because we look at the companies specifically, and we understand what are the risk elements and the justification around how that company currently operates. Because, like I said, if we're going to compare ourselves to the market approach, we tend to look at companies who are generally bigger than we are, who are either further along their journey or their maturity with regards to how they've worked, and therefore are probably more stable than we are. So how do we match up with that? And if we use the cost approach, the chances are we miss out on some of the softer elements of the business, right? We're looking at just purely assets and the fixed assets and the equipment on that premises. All right. So if you don't mind, if you do have questions, I'm going to ask you to hold them for a little bit, because I want to try and show you first how the discounted cash flow works, and then we can ask questions or we can share more examples after that.
Damion, maybe at this point is a good time to just run a quick little poll. People are quite often intimidated by words like EBITDA, and discounted cash flow and that sort of stuff. And it takes a bit of experience and a bit of understanding and working your figures to get comfortable with that. So I want to run a poll quickly just for the sake of getting a bit of idea how you guys are feeling about it. So if you don't mind, just answer questions. It's a multi answer question. So I'll just launch the poll now. All right, can you guys see the poll?
Yes, we can see the poll.
Excellent, thank you. If you just don't mind just completing it. You can choose more than one answer there. Let's give it a few more seconds. So knowing most of you, I will say to you that we can relatively easy within a bit of dedicated time, we can actually tell you the value of your business um, by working closer to you and looking at where you are in your financial state of your business, but also where you are going marketing wise and how you see the market currently under these difficult climates. All right.
Okay, I'll just share the results, Henk.
Okay.
Do you want to talk them through?
Yeah. So I'll just share the results for you. All right. So there's one person that says not for me. It makes no sense at this time in my business. Quite right, you know. But remember, you probably have got loan accounts on your balance sheet. You're probably putting in money to afford your expenses. So it could be worthwhile understanding, you know, how much more you're going to put money into run the business, and at what point are you going to get a return on your investment? Because if you take that money that you've invested in your business, you put it in a bank, without lifting a finger, you will get the interest on your savings or on your investments. All right. I need it, but
Henk, that was me.
yeah.
I'm just going to jump in there to explain the question relating to my business. For my business, it makes no sense, but this makes sense with some of my clients that I've been working with. So yeah, it was difficult for me to allocate my answer.
So
yeah.
when we next meet, Karen, maybe we can just talk around it a bit, because I believe even if you know it's got no value, you know what it is and where you need to go. Because obviously, you know, at some point you're going to need to know your value. All right, I need to know it, but I don't know how. So 4 people mentioned that. So we're going to show you a little bit how now. So don't get lost in the complications of numbers and that sort of thing. It's actually just sit back and then look at the result in the end, and it will make sense to you. I have an idea what my company value is. Great. So if you have an idea, also if you're dealing with us, talk to us a bit and let's work through and see if we can fine tune it and perhaps even have a plan to improve on it. All right. And then the last one is I need to know my personal asset value. So very important, you know, we've got 2 people there. If you don't know your personal asset value, it's time for you to get your personal financial portfolio in place and actually understand that you are not your business. All right. You're a separate entity to your business and you need to know your own value as well. So again, just an interesting one. All right, any questions there? All right, okay, Damion, over to you again.
So one of the key areas we look at when we try to understand our value, especially when we're looking at our intrinsic valuation, is obviously our finances. We have to understand where the business is going. And that first element to try and justify your business is financial management. So financial management, for those of you who have been part of our group sessions and so on and so forth, you'll remember that financial management talks about accounting and talks about finance. Now, accounting is focused on the past, finance is focused on the future. Now, why are those 2 elements so important? The reason why accounting is so important and why we want to look at the past is we want to try and get some idea of what has happened. Can I build on something that's already happening? So if in the past 5 years, the business has operated stably, the business model seems to have worked, and the business seems to be growing constantly at a rate faster than CPI, then I can safely assume that going forward, unless anything drastic happens, that should be the same trend moving forward, right? But the question will be is how reliable is that forecast and how much are they seeing growth at? Are they looking at investing at some point and taking a bigger jump or acquiring another entity to try and grow that revenue stream a bit more? What does the forecast look like for that business, knowing what the history has said as well? So when we look at our financial management and trying to value a company, the first question we have to ask is how do you have updated annual financial statements, right? So do you have a history? Do you have a record we can look at to understand where the business is coming from, right? The second question would be is do you have a forecast? So if you don't have a forecast, how do I, as a potential valuer or potential interest in your company, how do I know where the business is going? And again, when we go back to can you show me versus can you tell me, I would like to see it before I start asking questions. And if I've got to ask you questions, and if I can't understand where it's going, the chances are I will start quickly losing or quickly reducing the value that I envisage in your company already. We mentioned about the reliability of the forecast. So can you prove to me, firstly, that from a historical basis, the company can move forward and the company is continuously growing? But also, can you start justifying how reliable that forecast would be by saying, I've got customers who buy into me. I've got staff who can run this away from me so I can focus on other things like growth or strategic implementation. I've got a structure beneath me that is constantly growing or constantly using experts to move the business forward. I've got cash, which means I can invest in things like marketing and things like my sales team to try and get more of the revenue. Especially when we start looking at a forecast that starts talking about a 20%, 30%, 40% growth year on year, which is quite difficult to achieve in a settled company. As a small business, that growth is quite, I suppose, a lot easier because we're playing in a very small market currently, and we're going to start taking a bigger market over. But when a business starts settling in and starts reaching that maturity point, a organic growth of 5%, 7%, 2.5%, if you're looking at CPI now, starts looking very difficult to improve by anything more than 10%. So if it's more than 10%, how do I justify that 10% growth then? The next one would be, what assets and liabilities does the business currently have? So what are the value of the current fixed equipment or the current balances of the bank accounts, the loans from shareholders, or loans to creditors? How does that also affect the valuation? And because remember, anything the business owns or has debt to, the new owner will have to take over as well. So how do I start looking at the valuation through the balance sheet view of these are the assets and these are the liabilities as part of the valuation? So when we go a bit further now, so for anyone who's a bit financially scared, right? So I apologize for all the numbers, but this discussion or this view just gives you an idea of how the value of money changes depending on the length of time we have, right? So in this case, up to 10 years later or 10 years in the future, and how it changes when we have a interest rate or return of investment that a potential investor would look for, right? Now, when we talk return on investment or interest rates, that's what a potential investor or buyer will want to get back out of it. So for every 100 Rand spent, as an example, I want to get 15 Rand back, right? So at that sort of interest rates. So as a quick example, if we talk about the maths will be the value you're going to make in the first year divided by 1.15. So 1 being 100, right? And point being 0.15 being 15%, right? So we're looking at reducing the amount by 15% each year. If it's 2 years, you divide it twice by 1.15. If it's 3 years, 3 times by 1.15. Now, just a reminder, when we talk operating profits, as part of financial statements, we talk sales minus your cost of sales, which equals your gross profits, minus your expenses, which then reaches or produces your operating profits or your EBITDA amount, which we'll discuss more a bit later. So as we quickly run through the figures, you'll notice that 100,000 over the space of 10 years starts becoming worth less and less and less. So as an example, 100,000 Rand in 10 years time, right, today is only worth 24,000 Rand. Okay. Now that's what a discounted cash flow produces for us. It allows us to see how much we're willing to pay today, right, on a particular percentage, right, either on return on investment or even if you see it as a risk percentage, and how much will that 100,000 Rand be worth in 10 years time. Okay. Now, as an example, 15% is generally considered quite a good discount rate. So 24,000 Rand, 100,000 Rand being worth 24,000 Rand today, right? You'll see how if we start changing that and how we increase that. So let's go back there. A total of 1 million Rand over 10 years, for example, will only equal 501,000 Rand, right?
So
if we look at
Damion,
yeah.
sorry, just down that slide. So maybe just another way of explaining to everybody, and I often get asked this question. So I'm looking at you, Karen, and you telling me that you are going to make profit of 100,000 Rand for the next 10 years. So which means you're going to have 1 million Rand profit that you're forecasting, all right? And you've got all your figures in place and everything. And now I start negotiating with you. And in the end, I'm telling you that, listen, based on a lack of confidence here, maybe I don't believe these figures here, or you don't have this in place. I'm not prepared to pay you 500,000 Rand for 1 million Rand operating profit if I want 50% of your business, or I'm not prepared to pay you 1 million Rand to buy you out completely. I'm going to discount you at 15%. So I'm only prepared to pay you 500,000 of your 1 million Rand forecast. Okay. So in that way, I now, as an investor, is prepared to put in 500,000 with the dream that 500,000 will turn into 1 million Rand over 10 years. Okay. But there's a risk associated with it, and therefore I have discounted the actual profit that you're declaring.
Yeah, no, 100%, Henk. And then back to the point I was trying to make earlier, what was interesting for me, like my business, to value my business would be on the future cash flows. But that other business I was referring to, that they valued it not, and it wasn't on the future cash flows, it was on the actual assets of the business. So it was just a slightly different approach and different negotiating and negotiations. As I say, they looked at the balance sheets values of the assets and liabilities. They got that independent valuation, and then obviously also considered the different risks and that sort of thing. And then they came to an agreement on the value of the shares. So it was quite an interesting exercise. No, but thanks for that.
Right, I think we've got to move because we've got 10 minutes left of this hour, so we need to quickly get through this slide quickly. So same methodology now, guys. The question will be, as the risk starts increasing, so if we look at the 15% risk or the 15% interest, if you want to call it that, right? If that becomes 50% interest, it means my 100,000 rand is going to obviously start devaluing a lot faster, right? Now again, when we talk about the risk area, the least risk I have, the more that money is going to be worth, that future value of that money is going to be worth. As I start increasing the risk, the chances are that money will obviously be less. So if you look at a 50% discount rate or 50% interest rates, the chances are, or the end figure is a lot less than what that 50% figure is. And that again all comes down to how well can I justify to an external person objectively what that forecast and how accurate that forecast will be, how predictable that forecast will be. And that's why we go back to those 8 indicators. We talk about how impactful that risk will be, and then how do I justify a lower interest rate and get a higher return for my investments. Okay, so just if you understand the concepts, perfect. You don't need to know the maths very well. The concept effectively is the higher the discount rates, the less this money, this 100,000 or this million rand becomes worth over that period of time. So the more I can mitigate my risk, the lower my interest rate becomes, and the more valuable my business will become effectively. Okay, so as a real world example, Henk, do you want to please run through this? Yeah, I seem to have lost Henk. So just as a real world example, then guys, so we've done this for a few of our customers, trying to explain, or trying to get a valuation using both the discounted cash flow rates, but also looking at their current balance sheet items to get to a figure. So what you'll see on this side is a revenue line. So this is a revenue forecast of the previous financial years. The green area is the current revenue in the current financial year. So at this point, for example, we're only sitting in July, so there's still quite a few months left to the financial year. Hence why that revenue stream is a lot lower than what this previous one is at the moment. So you also go forward until financial year in 2025. So that's a 4-year forecast. What we then do is look at the gross profits, and the reason why gross profits important as a reminder is to understand the pricing point or the pricing strategy of that business. Now, as a comparison, if this company is either their gross profits way above the industry standard or it's way under, those are discussions we can start having with the shareholders, right, about why that is. Is it an issue with regards to the value seen in their business, as in from their customers' perspective, the customers are holding high value, therefore they can't charge a premium price, or are they working on a strategy of a penetration strategy, and therefore the pricing is very, very low to penetrate the market further? All those discussions can happen by assessing the GP percentage across their industries. We then look at obviously the operating expenses, but what we don't include here is the discretionary earnings of directors or shareholders potentially in there as well. And the reason is because as a shareholder or as a director, I'm potentially drawing a salary that might be bigger or might be a bit more complex than what a normal employee salary would be, right? So we remove that figure there, and we look at that, and we then get what we call your EBITDA amounts, so your earnings before interest, depreciation, taxes, amortization, and discretionary drawings. And we use this figure here to work out what's my net present value will be going forward. We obviously add the excess figures of interest paid, depreciation, tax, and discretionary drawings, and we have a look at what the net profit figure will be, because that's also vitally important.
So
the reason why that's important is because we finished, Henk. The reason why that's important is we want to try and make sure that the business model actually works at the moment, right? So either the business owners are running the company to a point of break even, right, which is perfectly fine as a small business owner, or they are still making a bit of profit every year. Okay, Henk?
All right. So the important aspect here is that everybody will tell you that you need to look at the net profit of the business. In fact, that's what you will pay your tax on. Your 28% of profits will go to SARS. So if you're running a profitable business, year on year, you're going to pay 28% tax on that net profit amount. So what we're saying is that let's skip the net profit amount to work it back into that EBITDA area, which we will call operating profit. And we basically say, but hang on, if you just look at year 18 there, year end 2018, you can see the net profit is 20,000 Rand. But we say, in actual fact, if you look at it, because the director is also the person running the business and making decisions on discretions on how to spend money, in fact, the profit is 170,000 Rand. So we look at 170,000 Rand rather than a 20,000 Rand as a starting point. And so we take it through all the way through to 2025, and we look each year at what is the actual operating profit rather than a net profit. We don't forget about the net profit. In the end, it comes through, but we're worrying about the operating profit. Now, what is important here is that Damion said, you learned from the past years. So we knew that we had, in the past year, 50% growth, 100% growth. And in the current year, we actually had a 50% drop in our revenue stream because obviously it's the pandemic and the market has taken a severe dump. We're under a recession and there's all kinds of corruption going on and all kinds of things impacting on our business lives. But looking forward, we can feel the business is recovering, the economy is recovering, or there's an opportunity for us. And we're going to grow by that 67, 80% forward now into the years. And then we need to understand what that operating profit will be. And that will then determine the amount of confidence that you will have as an investor in the business. And that will determine that discount rate that's marked in the red circle there. That's where that discount rate comes from. So if you can also, under your revenue and sales, break down and scale your products and services and show that to a potential investor, it will install more confidence. So in fact, you're making, say, 67% in the current year gross profit, but if you break down your products, it will have a variety of profit results leading up to that 67%. So it's a bit of a busy slide, but it's actually quite simple in breaking it down. And that, Karen, from your side, I would say that's what you need to look at to get to a value. It doesn't matter what a value is. It's more the discipline. It's more the understanding of what to look for so that you can prepare to drive your business in future. And then year on year, you do this assessment for your own benefit, for your own sake, because you are an investor in your business.
I think we've got to move on. We're going to run out of time if you carry on talking.
Okay. Thanks, Damion.
All right. So just quickly to add to that final point, guys. Remember, this is not the only document you will share with any potential investor. You will share things like your company organogram. You will share things like your net promoter score from your research you've done into how your customers feel about your business and your services. You will include things like a cash flow forecast as well to try and justify all of these figures here. So again, the better you can justify these figures, the better that discount rate becomes, and lower that discount rate becomes. So you can see from the operating profit made there, how when we add the discount rate, we can start getting to a net present value based on that EBITDA amount of those figures over there. So again, a total in this case of this business, a total value of 1.8 million, using that value of profit coming forward, but also looking at their current assets and their liabilities as well, according to their balance sheets. You'll just notice the next slide, when we change that rate again, we go from 1.8 million to 1.4 million when that discount rate gets increased. All right. So again, as an investor or as a potential assessor or valuer of the business, it's my job as the questioner to ask those questions about how do you justify these efforts, and then what discount rate do I look at putting in there to justify the risk taken by a potential buyer. And of course, like we said in the first slide, it's all about trying to justify that value and find a fair value between willing buyer and willing seller. The better I can motivate as the seller why this business is less risky, and the more I can motivate as the buyer why the business is more risky, I can get to that fair value again of what the final valuation would be. Now, Karen did mention it slightly. What Karen mentioned is that you can also use different mechanisms to try and get that value. So if you use the discounted cash flow, if you use the cost method, or if you use the relative method of looking at other companies and using the factoring scheme, you can try and find that midpoint between all three of those mechanisms, and you can then start looking at what that value is. All right. Just a few quotes quickly on understanding a bit of value. So I think this one's probably the biggest one. Nothing turns off an investor more than when an entrepreneur comes in with a ridiculous valuation. And those ridiculous valuations tend to be when we call our business our babies, or when we call up or we look at our businesses with an emotional attachment instead of being more objective. All right. So at this point, are there any questions, any comments? Anyone feel completely confused or don't know exactly where to look next?
Damion, I'm sorry, I'm talking a lot today. I've had a big aha moment when I saw that spreadsheet, because I've always tried to understand what happened with that experience I went through, and what you just did there, it makes 100% sense, because you did the discounted cash flow or the future cash flow valuation, and then you adjusted it for the assets and liabilities that the business had at that point in time. Which includes the goodwill, which I suppose is quite an interesting discussion as to how to value it, but that makes 100% sense for me now. So you actually answered a question that's been bouncing around in my mind for a long time. So thank you.
Good to hear, Karen. So I think the same thing there goes, how do you find the best value for your house? You don't ask one estate agent, you ask multiple, right? And you see what their opinions are. And using all those opinions and all those valuations, you can then find your best fits to define and justify what that value would be. And the same thing would go for any normal business valuation. What methods can I use to get a range of results and then find that best value that fits for me?